Hi there, I'm back. It's me again, Christine, your auditing theory conversation partner. Did you miss me? Now, if you have been paying close attention to the previous videos that we have had, particularly the first module on the introduction to audit and assurance, then you might have noticed that we mentioned something about how we gave an overview to auditing, but not really the audit process yet. Well, surprise, surprise. In this module, we are finally going to give an overview of the financial statements audit process. So, this will no longer be simply skimming the surface as to what auditing is, but we're finally going to take a deeper dive into what the financial statements audit process is like. So, if you will, it's kind of like taking our bolang cristal, our crystal ball, and taking a peek into your future as external auditors and what do you expect to do when you finally perform an external FS audit? Now, truth be told, if we were to discuss each phase in the overview, then we would have, if we were going to discuss it thoroughly, then we would have already effectively discussed the entirety of the auditing theory syllabus. But then, of course, that would be a bit too overwhelming. So, to help make things more digestible, we're going to give a special focus on client acceptance, audit planning, supervision, and monitoring. Now, before we jump into our discussion, I also do listen to your feedback. And one of the things that I have received, one of the feedbacks that I have received is that the lengthier videos, like the previous one we had, which ran for about an hour, aren't really as effective as we would have hoped it to be. So, therefore, we're going to do something different in this module. For each of the segments we're having for this module, I am going to try and limit our discussion to 25 to 30 minutes. Hopefully, that will be better and that will assist you better in terms of the retention of the concepts. So, are you excited? Because I sure am. Let's take a look at how we're going to divide our discussion for this module. So, these essentially are the topics. We're going to give an overview of the FS audit, and of course, we're going to give the overview of the audit process. Client acceptance and audit planning would go into the overview of the audit process together with pre engagement procedures, scope, and purposes of audit planning. Now, honestly, audit planning takes up a bulk of the discussion and our conversation here. And then finally, cap it off with direction, supervision, and review. So let us start with the overview of the audit process. Now, whenever we talk about the FS audit process, we think of these phases. And yes, there is a reason why the phases are arranged that way. We arranged the phases this way because now might be a good time to tell you about the risk based audit approach. Our FS audit process embraces what we call the risk based audit approach. And at the core rather, of a risk based audit approach are actually three distinct phases. How many distinct phases? Three. The first distinct phase is risk assessment. And when we perform risk assessment, that is where pre engagement procedures, audit planning, and of course the risk assessment procedures would belong to. Now, once the auditor has assessed the risks, meaning to say identified and evaluated the risks, then the auditor will of course respond to the risk, right? Once we have evaluated something, we don't just sit back, relax, and enjoy, but we respond to the risk. And finally, after the process of responding, where audit evidence gathering procedures will play the main character role, then the auditor will, of course, complete the audit, issue the audit report, and perform post audit responsibilities. This is the phase we refer to as conclusion and reporting. So, essentially, the three phases of the risk based audit approach is risk assessment, risk response, and conclusion and reporting. And all of these steps or phases fall distinctly into each of the three distinct phases as well of the risk based audit approach. So, where do we begin? Well, they do say let's start at the very beginning. It's a very good place to start. So, we get to talk about pre engagement procedures first. When we think about pre engagement procedures, as the term would suggest, pre, that means it happens before the actual engagement. We essentially look at client acceptance. And when we say client acceptance, then this means either accepting a new client or it could be accepting an old client, an existing client, for a new engagement. Now, this section will also talk about client continuance, whereby we think about an existing client with the same engagement and as to whether we will continue or not. Now, whenever the auditor decides whether to accept or to continue a client, the auditor must evaluate and look at a number of things, such as, for example, the auditor must evaluate his or her competence. We must remember that we are not allowed to accept engagements where we are not competent to perform them. Okay, another is ethical requirements, and ethical requirements will, of course, be anchored deeply into the code of ethics. And it is at this point where we get to remind ourselves of the requisite for independence. We have to examine the possible relationship we'll be having with this client and if there will be no violations to the ethical requirements, most especially that on independence. The auditor must also look into the capabilities of the auditor, meaning to say, does he or she have the time and the resources to finish the said engagement? So at the onset, the auditor does a self reflection. Now, there are often situations that are being asked, particularly if this were, a classroom undergrad discussion, and perhaps your auditing theory teacher might have asked you about what if there is a prospective client that has visited you in your office. Now, the client wants to get you for, an external FS audit engagement, but then it just so happened that this client is working on an industry that you have never had any experience before. Let's just say, for example, the client is a school, it's an educational institution. And so far, all of your existing clients are into the merchandising buy and sell industry. And you have never audited a school or an educational institution or something similar ever in the past. You have never had an experience auditing a school in the past. And then most likely the question would be, could you accept the engagement? Would you consider accepting the audit engagement, considering that the industry where this prospective client belongs to is something that you have never experienced yet? Now, particularly looking into the requirement of the auditor to evaluate its competence, the question now is, will you accept the engagement? Or can you accept the engagement? Now, the long and short answer to that is yes, you may. And then some students might ask, but miss, does it not mean that I am not competent to perform the audit because I have never experienced auditing that industry ever? Now, take note that what is required for you is to have that competence to perform the audit. By virtue of you being a certified public accountant and by virtue of you being in public practice, are you competent to perform the audit engagement? The answer, of course, is yes. Yes, you are. You already have the basic competence to perform the audit engagement. But then, Miss, how about the industry? I have never audited that industry ever in the past, and so therefore I am not yet competent. Well, guys, the good news is you could always acquire that. The important thing is the very foundation. Do you know how to conduct an audit? Are you qualified to conduct an audit? If your answer to that is yes, then you can just acquire the necessary understanding of the client's industry and business later on. But at the end of the day, the long and short answer to it is yes, you may accept such engagement, provided, of course, there are no violations of the ethical requirements and you have the capabilities to perform the audit engagement. Okay, but our evaluation does not just stop there. The auditor should also evaluate the auditability of the prospective client. Do you remember in our discussion regards an appropriate subject matter? We said that for a subject matter to be appropriate, it must be identifiable, it must be measurable, and it must be testable. In fact, one of the elements of an assurance engagement is for you to be able to get sufficient and appropriate evidence. So you need to determine, can I audit this client? Is the prospective client auditable? And what do we look at when we decide whether it's auditable or not? Well, two things: determine the adequacy of accounting records, and the quality of the client's internal controls. Both of which, by the way, are the responsibility of the prospective client. But in order for us to perform an audit, we need to know, are there records? Does the client have a system of internal control in place? If the client gets a check mark for both, then we may consider accepting the client and or the engagement. And then, most importantly, we need to evaluate management's integrity. integrity. I cannot stress this enough. Do not associate yourselves with clients who lack integrity because then things will become very complicated. Once you're already in the engagement, once you have already signed the contract, and then at that moment you realize, oh, this client has questionable integrity, it's going to get more complicated. So from the very start, filter out clients with questionable integrity. Assess, evaluate client management's integrity. And how do you do that? Sometimes it's easier said than done, right? But then how do you do that? Well, you can review the company's financial statements. You can discuss the company's management with the predecessor auditor or those which we call the ex-auditor. Now, as a successor auditor, if you're the auditor who is about to receive that client or to receive that engagement, do you know that it is your responsibility to initiate communication with the ex auditor or the predecessor auditor? But then, of course, because we are all bound by the ethical requirement of confidentiality, this communication must receive the blessing of the client first. So, as the incoming auditor, the new auditor, you will have to ask permission from the client. Okay, you will have to inform the client that you're going to communicate with the ex auditor or the predecessor auditor. If the client gives the go signal, then you will be free to talk to each other. Okay, but if the client does not give the go signal, well, wouldn't that be considered as a red flag? Why wouldn't the client let you talk to the ex, right? But then let's think about this conversation. Imagine yourselves maybe in a coffee shop or having lunch together with the ex auditor. What are the things you're going to talk about? Now, would that be an awkward conversation? I don't know. But what are the things you're going to talk about? Well, essentially three things. And we summarize these three things by the mnemonic RID, RID, RID. Essentially, we want to know why were you gotten rid of? Okay, so R stands for reasons for the change. You have to ask why things didn't work out for them. Because the reason why things didn't work out for them might very well be the reason why things will not work out for you in the future. What do we mean by this one? Say, for example, the reason for the change has something to do with a disagreement regards how to apply an accounting standard. Whether or not you are the auditor, then the accounting standards remain the same, right? So if they disagreed with that, then most likely they will also disagree with you on that because you're talking about the accounting standards, and accounting standards do not differ from auditor to auditor. Okay, so then this gives you an idea of why things didn't work out for them. Of course, there are a lot of valid reasons why there has to be a parting of the ways, right? It's possible that there might be disagreements with regards to fees, or maybe the client needs services that the ex-auditor cannot provide, and so therefore they're looking for another one. But at the end of the day, you need to know what are the reasons for the change. You also need to ask letter I. I stands for integrity. You have to ask about the integrity of management. And letter D for RID, letter D would stand for disagreements that they may have with management. Okay, so these are the things you're going to talk about with the predecessor or the ex auditor. You may also want to discuss the company's management with members of the financial community, like maybe creditors, bank institutions, or some other stakeholders that might give you an insight as to whether management has integrity. Consider engaging professionals or investigators to evaluate the principles associated with the prospective client. I happen to know that some audit firms do this one. It's kind of like a background investigation into a prospective client and obtain credit reports when deemed necessary. So, all of these things hopefully will give you an idea as to whether the client's management has integrity. We have to be on the lookout, for example, for negative news, or perhaps too aggressive, overly aggressive stand with regards how to apply gray areas in the accounting principles. That would also give you an idea as to the integrity of management. Now, for client continuance, like I mentioned, there might be valid reasons why you wish to discontinue an engagement with an existing client, such as, for example, of course, if there is evidence indicating that a client's management may lack integrity, then best for you to exit. Okay, so difficulty in working with client personnel. We have to remember as well that part of management's responsibility is to ensure that we are able to perform our audit. And so, if management somehow, or if the personnel of that client somehow seems to be actively working against you, it may also be a reason for you to discontinue the engagement, or the inability to negotiate an acceptable increase in the fee. Yes, that is a valid reason for you to discontinue the engagement. Or if the client needs specialized services that the current audit firm is unable or unwilling to provide. These are reasons for why clients discontinue or auditors discontinue with the engagement, no, of their existing clients. Now, once the auditor has made the decision to continue or to accept, then the auditor and the client must reach an agreement. Okay, the terms of the engagement should be reached, or an agreement with regards to terms of the engagement should be reached with the client, preferably through the auditor about the professional services desired, and an engagement letter is, of course, prepared. Now, an engagement letter stands as like the contract between the auditor and the prospective client, and this is to be sent preferably before the commencement of the engagement. So, like what we have mentioned, it's a formal written agreement between the CPA firm and the client for the conduct of audit and related services. It's a written contract because it's a letter, so it must be in writing. It's a written contract between the auditor and the client. There is a need to utilize engagement letters in order to minimize understandings, because sometimes the client may have a different idea as to what an audit entails from that what the auditor expects, no, or what the auditor can actually offer. So therefore the engagement letter can provide, no, this avenue to minimize misunderstandings. This would also alert the client as to the purpose of the engagement and the role of the external auditor. And it will help minimize legal liabilities for services that were neither contracted for nor performed. So the engagement letter will contain the details of the engagement and will attempt to outline important things relating to the scope of the engagement. What are the parameters with which the auditor will conduct the said engagement? So these are the contents of an engagement letter. They are quite a lot, so don't get too overwhelmed. But it's important that we are familiar with them, because sometimes the multiple choice questions would ask something like, the following are the contents of an engagement letter, except. Okay, so let's take a look at the contents of the engagement letter. Of course, we have to put there the objective of the audit, and we have to make sure that management would understand what are the responsibility of management for the FS, to ensure that there will be no misunderstandings, no, along the way. We also outline, or we mention, the financial reporting framework adopted by management in preparing the FS, because this will become the criteria that we use when we evaluate the subject matter information. We, of course, put in the engagement letter the scope of the audit, like I mentioned, what are its parameters, the form of any reports or other communication of results of the engagement other than the audit report. Will there be other reports that we expect to submit to management? The fact that there is an unavoidable risk that even some material misstatement may remain undiscovered. So this is one way for the auditor to alert management of the very concept of audit risk, right? It's possible that there may still be misstatements which our audit may not be able to uncover. This is also where we outline that management should give us unrestricted access to records, documentation, people, and others. And also, what is management's responsibility for internal control? Included also in the engagement letter are arrangements regarding planning and performance of the audit, and an expectation of receiving from management written confirmation of representations made. Now, the written confirmation of representations made, we normally ask for management near the end of the audit, but at least management knows at the very start that we will be asking this from them. The request for the client to confirm the terms of the engagement by acknowledging the receipt of the engagement letter, description of any other letters or reports that you expect to issue to the client, similar to the form of any reports or other communication that we mentioned a while back, and then, of course, the basis on which the fees are computed and any billing arrangements. The last one, perhaps, being where you would be most interested to look into. But yes, fees and billing is included in the engagement letter. Now, very quickly, let's talk about the audit of components and what is its impact, or what what do we need to know with regards audit of components in the context of engagement letters. Now, a component is essentially a subsidiary, a branch, or a division. The big question now is, should you send a separate engagement letter to the components? The answer is it will depend. It will depend on certain factors such as who appoints the auditor of the component. Is a separate audit report to be issued on the component? Okay, are we legally required to send a separate engagement letter to the branch, the subsidiary, or the division? What is the extent of any work performed by other auditors? What is the degree of ownership by the parent? What is the degree of independence of the component's management? And so you see, whether we send a separate engagement letter to the component will depend on these factors. Now, we also get to talk about recurring audits. Do you need to send an engagement letter to a recurring client, an existing client, for recurring audits? The answer is you don't actually need to send an engagement letter every year, but you might find the need to send a new one if you find the following things. For example, if there is an indication that the client has misunderstood the objective and scope of the audit, you may want to send rather a new engagement letter just to ensure that they understand things clearly, or if there are any revised special terms of the engagement. Or take note of this, if there is a recent change in senior management, board of directors, or a change in the ownership of the business. Take note that the recent change must happen in senior management, BODs, or the ownership of the business. That being said, if there is simply a change in the staff or the employees of your client who do not occupy a senior role, then there's no need for you to send a separate or a new engagement letter. But once the changes involve senior management upwards, there may be a need for you, or you must send a new engagement letter to ensure that you guys still agree on the same terms. If there's a significant change in the nature or size of the client's business, say, for example, from sole proprietorship, the client has now decided to go into the corporate setup. So send a new engagement letter. And of course, if you are legally required to do so, then by all means, if the law so requires, we send a new engagement letter. Or if there's a change in the financial reporting framework adopted by management in preparing the FS, in other words, when the criteria has changed. So if, for example, previously the client made use of IFRS for SMEs, and now they are going to transition to full IFRS, then send a new engagement letter. Now, what if there are changes in the terms of the engagement? What would you do? Okay, so for example, you were initially contracted for an audit, and the client suddenly told you, well, not necessarily suddenly, but then the client told you, hey, you know what, auditor, I just realized I don't want an audit engagement anymore. Can we just, can you just do a review? So there is a change from a higher level of assurance to a lower level of assurance. Will you agree? Okay, so well, again, the answer to that is it depends. What is the reason for the client's decision to change the engagement? If you find the reason to be justifiable, then by all means agree to the change and do not make mention of the old engagement because you have already agreed. So when you agree with the client that there really is a need to change the engagement to a lower level of assurance, then do the new engagement, proceed with the new engagement, move on, do not mention the previous engagement so as not to cause confusion on the readers of your report. Okay, unless of course the new engagement is agreed upon procedures, because if it's agreed upon procedures, you will have to mention the previous procedures. But if it's not agreed upon, please do not make mention of the past. Past is past. Okay, that is if you have agreed to the change in the term. However, what if you do not find the reason to be justifiable? What if somehow you sense that the client is simply requesting for a change in engagement in order to avoid a possible modification of the audit opinion? What if the client senses that you are going to give a qualified or adverse opinion? And because of that, the client simply asks you to change the engagement to agreed upon so that you will not be able to give an opinion. And because of that, you are not convinced that there is a reason for the change in engagement. What will you do? Well, of course, you refuse the change in engagement. You continue with the original engagement. Now, if you are not allowed to continue with the original engagement, then withdraw from the engagement. So, in short, will you agree to the change in the terms of engagement? It depends. If the reason is justifiable, such as, for example, the client does not anymore need an audit, then accept the change in the terms of the engagement, then continue or proceed with the new engagement. Do not mention the old unless it's agreed upon. But if you're not convinced with the reason given by the client, you don't think it's justifiable, continue with the old, continue with the original. If the client refuses or does not allow you to continue with the original, then withdraw from the engagement. Okay, so like what we have mentioned, no, there may be reasons may prompt a change that would prompt a change in the engagement, like change in circumstances. There may be a misunderstanding or a restriction in the scope, whether imposed by management or caused by circumstances. And like what we have said, carefully consider the reason given for the request, particularly what the implication of this in the scope of your engagement. All right, so I think we have reached 25 minutes, and thankfully we have completed already the first phase, which is pre engagement. Now, the next phase is a bit lengthy. There are a lot of things to discuss because this is also where we're going to talk about materiality. So, I hope that you still have the energy. You should have the energy because the next phase is going to be exciting. But perhaps what you can do, you could end this video right here, and before starting the next video, you may want to take down some notes first so as to capture the concepts we have just discussed. All right? So I hope to see you in the next video where we will discuss audit planning.